um, the agenda. Introductions were too big of a group to go through. I do like to know who I'm talking to. So if you would put in chat if you're a sole proprietor, if you're a single member LLC, if you're a partnership or an S Corp, or what's known as a C Corp, or any little tidbit that you want to share with me so I know who I'm talking to, I would appreciate that. Because then I can help gear my comments to the majority of the folks attending. But there's a C Corp, single member LLCs, some S Corps. Okay, good. Thank you all for playing with me here. Single members, another C Corp, taking some classes, good. Great, okay, that's S Corp, good. Sole proprietor, business students, awesome, 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 awesome. Okay, so we're going to go through some terminology, the equation, again, the simple system, and typical financial statements, so called Flossie the Florist. You know, what's the story that these financials are telling us, and finish up, and we'll be done by around 2:30 is the goal. So again, introductions we're going to skip. Thank you for playing and telling me who you are in the chat. Keep it coming. And so what is assurance? That's a term that you hear a lot in the accounting world. And, you know, there's a common thinking out there is like, well, why didn't the auditors find that in the financial statements? Why can't, you know, how did this happen? The auditors should have seen it. Well, yes, probably they should have, but it's not, the word audit is a term of art. And so in this diagram, you can see audit is the top of the chart, so to speak, and bookkeeping, accounting, and tax is at the bottom. So as you go up the chart, things become more complex. There's more things that have to happen that your CPA will do or not do. A compilation is very typical from a CPA office, that they take your information and turn it into financial statements, balance sheet, and income statement. They'll ask you some questions along the way, but they're not guaranteeing anything. As you go up the chain to review, there's more steps that are taken. There's more questions asked. There's more sampling. There's some digging deeper into how did these transactions come about? Where are they coming from? And then audit is even more so. And so you can't look at every transaction in a large company's financial statements. So you do what's called sampling and so on. So it takes a lot of, I've never done an audit. I've been a CPA for a long time, but I have always worked in the compilation and below stage. So there's different sets of skills that folks have. And I have a passion for small business owners. I grew up in a family business, and my dad, you know, did not keep up with this stuff. And it caused a lot of anxiety and a lot of, shall I say, fighting between my parents, that they had these discussions. However, they thought that I wasn't hearing them, but being an only child, I pretty much heard everything that they were talking about. So I kept growing up saying there's got to be a better way to do this. You know, there's always a discussion of, is there enough money? Do I have enough money to do this? You know, one of the things I remember when I was in elementary school, I could hear my mom ask my dad, I need money to buy Lisa some new school clothes, you know, in August and September. You know, it was a constant thing. Is there enough money? Can I have some money? I need money. So there is a better way to do it, and that is doing this compliance work consistently, routinely, and having the numbers at hand and understanding what you're looking at. Because, you know, you start a business because you're very excited about whatever that it is, your passion. If you're a dance instructor, or if you're a counselor, if you're a graphic designer, what have you, you have this set of skills, but no one ever really taught you how to run a business, I'm betting. And so what do you need to do? So as you grow, your gut can only tell you just so much. You have to make sure that your gut is right by looking at the financial statements and saying, yes, this is reflecting reality. So years ago in my tax practice in Austin, I remember a client coming through the door and he said, well, and he just kind of threw these financial statements on the table. And I said, well, these are great, but he looked, I said, do they reflect reality? And he said, I have no idea what they say, but I'm sure that they don't. And it's like, well, why spend the money to have a bookkeeper or an employee do all this if you don't rely on them, if you think that they're not right? So having an understanding of how to put this stuff together so that it is reflecting your gut and that you have these processes in place to be able to do what you want to do. I mean, in the end, we need good financial statements to do your tax return. Everybody's got to file a tax return, and to understand how your business entity structure affects your total tax picture is the key, is one of the main keys, because cash is king. And if you run out of cash, you're probably going to run out of, your business is going to fail. So understanding the cash flow, understanding the tax effects, understanding how to read these financial statements. You don't have to know every single thing of how to do it, but if you have the basics understanding of what they're saying, are they reflecting reality, then the folks who are in the business of doing this can help you plan and strategize your equipment purchases, your tax strategies, how to save money for vacations, college, for your children, a new home, whatever it may be. So the basics are important. So having a good bookkeeper, either you or hiring that out, is essential, because that's the beginning of the building blocks of knowing that things are categorized correctly and that everything is captured. So the financial statements, when we use the term financial statements, we're typically talking about, as I said in the previous slide of the course objectives, a balance sheet, an income statement, then a cash flow statement. So all of those make up the general term financial statement. And the balance sheet and an income statement are the primary two statements that you will be looking at. Cash flow statements, we're going to cover at the very end. And sometimes it's a little hard to wrap your head around just what that is, but hopefully the slide will help you understand what goes on with the cash flow statement. Again, my small business clients, I deal mostly with folks who have probably less than 5 employees over on the whole. We're small businesses, and it's, knowing how much cash we have in the bank and knowing how much cash we're going to need is key. So I see in the chat, is the income statement the same as profit and loss statement? Yes, that's one and the same. It's just what you choose to call it. So thanks for clarifying that. Okay, let's see. But before we get into the actual financial statements, looking at a balance sheet and income statement, I want to talk about the cash basis of accounting versus the accrual basis of accounting. And what does that mean? Well, cash basis of accounting means that when you pay for something, you record it. When you receive payment for your services rendered, you record it. As opposed to accrual basis is when I complete that project and I prepare my invoice to my client, I record my sale at that point. I have not collected my money yet, but I have completed my job and I have an accounts receivable. You owe me. And so it's recorded as revenue at that point in time. Similarly with expenses, when you incur that expense, when I have the office supplies delivered to my office and I have 30 days to pay for them, I recognize that expense at that time because I have those goods in hand. I owe for them, but I have 30 days yet to pay for them. So cash basis has everything to do with cash when I get it and when I pay for it, versus accrual has everything to do with recognizing the income and the expenses when the my mind just went blank. When it happens, when I invoice that client, that's when I recognize my revenue. When I receive my goods and I have not yet paid for them, then I am on accrual basis. I record that expense upon receipt of the invoice that I have to pay. So does that make some sense for everybody? Give me some feedback either in chat or speaking up. By unmuting. Yes, yes, yes. Okay, great. Thank you. So let's go to the next slide that gives you a little bit of a graphic on these two methods of cash basis versus accrual basis. It's all about when do I recognize my revenue and expenses. So cash basis, as I mentioned, is time of the cash payment, when I get paid, when I collect my money, when somebody pays my invoice by credit card or check or cash, that's when I recognize my revenue. When I pay for things, that's when I recognize the expense. As opposed to the accrual basis, it's at the time of sale. When I present that invoice, that's when I recognize my revenue at that time and the expenses at the same, similarly. So is one better than the other? Should I be on cash basis? Should I be on accrual basis? So here's a question in chat. Let me see. Well, first of all, everything on credit is accrued. Can you explain why we must use cash basis for tax returns if we're generally on accrual basis? Okay, let me, you're right on track here with me of where I was headed. So accrual basis, so anything on credit is accrued, meaning I have presented my invoice to you. You have 30 days to pay me. So I have extended you credits. So from that perspective, yes, you are accrual basis at that point. There is a little question, somebody? Okay. And the same thing with expenses. So I think, you know, that's kind of that's one way to talk about cash versus accrual is, so everything on credit is accrued. It's a little bit more than that, but that's a good place to start to wrap your head around it. So the next question is, can you explain why we must use cash basis for tax returns, even if we generally are on accrual basis? Perfect question. That's exactly where I was heading. Is cash basis better than accrual or vice versa? I would recommend that you keep your books on the accrual basis, because that tells you what you have done in that month, meaning the sales that I have completed, and and as well as the expenses that I have incurred to produce that revenue, in so many words. So how much did I do in sales, and how much did it cost me that month to do it? Why would I want to know that versus just when I collected my money and when I paid for it? Well, you can use the accrual basis as a method to analyze some trends. For instance, in my tax practice, as all of you can imagine, I'm sure, you know, January, February, March, April, and even into May, we are very busy. It's a seasonal business. And I'm sure some of you have seasonal businesses as well. So In April, it's going to be more than likely the busiest month that we have. That's where we're going to have our biggest sales volume on the accrual basis, but we may not collect our money until next month, into the month of May. But I have to know how to staff up for my business for that seasonality. So from the accrual basis information, I can see those trends. My gut also tells me, of course, but I can see that I really need to have somebody on staff ready to go in the month of February so that we can really crank out the work in March and April. So if I was making that decision of when to staff up based on a cash basis method, I may not have the best information at that point. So depending on your business, you may be all cash basis. You may not have any sorts of receivables or payables out there. Or that may be the business model that you have, is that you are extending credit. Going back to the previous chat comment, you may be extending credit to everybody. And so it will be you know, if you're completely accrual basis, then you'll know, you know, how busy you are in that period of time. So so let's talk about tax returns, where the question is cash basis for tax returns if we generally are on accrual basis. Most small businesses will file their tax return on a cash basis, because I don't want to pay taxes on money that I have yet to collect. I think that's the bottom line. Most companies, large companies, are required to file on the accrual basis, but small businesses, we are not. So we typically will file our tax return on the cash basis. So if you're working with a tax preparer, that's a question that they're going to ask you when you present your financial statements. You'll be asked, are these accrual based or are these cash basis? And then you'll have the discussion from there of how we were going to report all of this information on your tax return. On the tax returns themselves, no matter what kind of business entity you are, there is a question that says, is this tax return cash or accrual? So you need to know the answer to that when you're asked. You need to know how you are paying taxes, meaning if I'm paying taxes on accrual basis or on cash basis. Accrual basis is typically where you will see the account for bad debt expense. That means you have not collected a receivable, but someone has stiffed you, so to speak. On cash basis, you will not see that category, because cash basis means you're only recording revenue as to what you actually have been paid. So you will not see a bad debt expense in a cash basis statement. If you do, then it's done wrong. So we have any other questions? Which type cash accrual based tax return would you recommend? Which would be more simpler to handle? I recommend that you do your books on accrual basis and you convert it to cash basis for your tax return. In all my years of doing tax work for small businesses, I've only had one client that filed their tax return on an accrual basis. It's just not common for us as small business owners to prepare our tax returns on accrual basis and pay tax on money we have yet to collect. We don't have the cash sitting in our account to pay the tax if it's sitting in an accounts receivable. Is it easy to go between cash and accrual using accounting software? Yes. In QuickBooks, which I'm most familiar with, I'm not familiar with the other accounting software out there. But when you call up the reports for a balance sheet or for an income statement, there is a place to click. Do I want this to be cash basis or accrual basis? And so the software will do it for you very easily. However, you know the old saying of garbage in, garbage out. So if your person who is preparing, working in your QuickBooks is not entering information consistently, routinely, then when you click between cash and accrual, you're going to have garbage. You know, you've got to have your books right to actually have good information to work on. So there's a lot of bookkeepers out there that are worth their weight in gold. And there's a lot of bookkeepers out there that don't know what they're doing. So do your due diligence when you're hiring a bookkeeper, that they really do know what they're talking about. And part of doing financial statements is to do them timely, as I had said before, but that typically means every month. And so you want to reconcile your cash accounts, your bank accounts, your credit card statement accounts. By reconciling those accounts, which in the software, there's ways to do that, but making sure that what you think you have in the bank on your checkbook register versus what the bank says, accounting for outstanding items, stuff that hasn't cleared the bank yet. If you know your bank statement is reconciled, so you have to download those bank statements from your bank every month and go through the process of reconciliation, that gives you the confidence that everything has been accounted for. All the money's going in has been accounted for. All the money going out has been accounted for. We may have some errors in just where things have been categorized, but if cash balances, then we know everything is in the financials. We may do some tweaking, we may do some moving around, but if cash is reconciled, then we know we're good. Similarly, your accounts receivable, if you can turn to that and go, yep, that's who owes me, that person is paid. So on your balance sheet, you want to look at each balance when we'll get to the balance sheet. Make sure that you can tie back to something that says, yes, that's the right answer. Particularly, another example would be in your liability section, which again, we'll get to when we look at it. If you have a note payable at the bank, they will give you the information of how much interest you have paid on that note and what the principal balance is at the end of each month, or particularly at the end of the year. We want to tie out, that's one of my terms. We got to tie this out. We got to make sure that everything, what is in our financial statement, we have data for that backs it up, that says, yes, that's right. So are there any other questions on cash versus accrual? Accrual, again, I think gives you the information to make your management decisions. It can give you some trend analysis. It can tell you how long people are out there not paying me. If you do an accounts receivable, do they pay within a presentation of the receipt? Do they take 10 days to pay? Do they take 30 days to pay? What's the trend? Do I need to up my prices? Do I need to not be so lenient in my extension of credit? Remember, you are not the bank. You want to get paid. You want to be paid today, as soon as you can. Okay. Which would be more simpler to handle? Back in the chat, a couple questions. Cash is simpler, probably. I mean, a single entry method is simpler. And what I mean by single entry versus double entry, we are going to be talking about double entry accounting. Think of single entry accounting as my check register, and I just write everything down on my check register. I'm not categorizing it in any way. Okay, let's move on here, unless we've got another question. Okay, so the accounting equation. This is accounting 101. When you first start in business school and you take the accounting class, you have your assets equals your liabilities plus owner's equity. This is true for any financial statement, any size company, from the one person shop to the company who employs thousands of workers. Your assets, which are your cash accounts, your accounts receivable, your fixed assets, meaning your furniture and equipment, buildings, perhaps all those assets will equal what you owe plus the equity in your business. This owner's equity can be called a couple of different things. It depends on your business structure. So for a sole proprietor, that's what it would be called, owner's equity. For a single member LLC, it would be called members equity, because that's what you are as an owner of an LLC. You are a member. If you're in a partnership, it would be called partners equity. If you're in a corporation, it would probably be called retained earnings. So there's some different parts to it that we're going to look through as well. So this is the basic equation, no matter how big or small you are and running your business. So we have to know the different kinds of accounts that go into this formula. So double entry accounting. Debits have to equal credits, and I'm betting that all of you have heard that term somewhere along the way. So if I have a, if I buy an asset, if I buy a building, I'm going to increase my building account, and I'm going to decrease my cash account if I pay for it. That's all it is. It's categorization 2 times. You know, something's going to increase and something's going to decrease. Debits have to equal credits. Depends on the kinds of accounts of what kind of balance that financial statement will usually have, that account will usually have. But hopefully that'll come a little clearer as we go through them. So debits equals credits. So this is the first handout that I have for you, the Cash Disbursements Journal. This is a simple way of keeping up with what you have. This is done in an Excel spreadsheet. This is what accounting software will do for you. So as an example, Flossie the florist, we have checks 101 through 122. Who did we pay? Who did we write the check to? And then as a credit, because we're taking money out of our cash account, out of our asset cash account, by default, that's a credit. Here is the amount of the check that we wrote for each person, each payee. And then across the top here, you'll see different categories of expenses. And those expenses are all debits. So we increase our expense, we decrease cash. So you just spread it across. So the first payee is to Office Depot. We spent $5,000. So we bought some furniture and fixtures. The next check that we paid was to Flower Supply. We wrote it for $25,000. And so that goes into our flowers account in our cost of goods sold section on our profit and loss statement. Kinko's was for some advertising. I had some flyers printed up, whatever. Flossie the florist, this is the name of our business. So Flossie wrote a check to herself for $12,165. And that comes over here in this last column called draws. Draws are the way that sole proprietors, single member LLCs, partners and partnerships take money out of their business account. It is not a paycheck. It is a draw. That's the terminology for it. In the S-Corp world, for those of you who are S-Corp owners, it's called a shareholder distribution. So it's the same concept, just called something different, just has a different word. So when I hear the term shareholder distribution, my mind goes to, oh, you must be an S-Corp. When I hear the term member draw, then I know that you are an LLC business entity. You may be a partnership if you're an LLC as well. So anyway, here I think you can get the gist. So for all year long, you just keep a running total of everything that you have spent. I'm keeping track of what I have paid for. And so this would be cash basis here. I'll get back to your questions over here in chat in just a moment. So we want to categorize each expense. And so obviously the more transactions you have, the more time consuming it's going to be. This is where accounting software comes in to help you to do this categorization quickly and do the math for you as well, as opposed to in a spreadsheet. You can set up formulas to do the math, to add up the columns. If you're doing it by hand, then you have to run the calculator and add it all up. But this is how accounting started back when. You hear about the ledger sheets or the 13 column sheets. It's all it was someone writing down everything and categorizing it. And then you categorize it by the month, by the quarter, by the year, etc., year to date. So let's see back here in chat. So credit bank account, debit individual supplier accounts. Yes, that would be correct. Is member draw the best way to pay yourself in an LLC structure? Absolutely. Let's go back to this concept of paying yourself. If you are an S Corp owner or a C Corp owner, then by definition, you are an employee of that corporation. When you are an employee, that means you get paid a payroll check. Just like anytime you've gone to work for anybody else and you've gotten your monthly check or paid twice a month, whatever it may be, you get your W-2 at the end of the year. That's what I mean by payroll. You are an employee, you are paid payroll. When you are a partner in a partnership, a single member LLC, or a sole proprietor, you are not an employee by definition. By IRS rules, you are not an employee. Therefore, you do not get a payroll check. You do not get a W-2 at year end. How you get paid, how you take money out of your business is called a draw. And in the S Corp world, there's a hybrid here where you have to be paid a W-2, but you can also have a shareholder distribution. In your world, it's a shareholder distribution. In the partners, LLCs, and sole props, it's known as a draw. Same theory, just a different name. The money that you put in your pocket has nothing to do with how you do your tax return. And let's get to the actual financial statements, and hopefully that will come to light a little bit more. So let's see, how detailed do these ledgers have to be? And cash disbursements journal, is this a different sheet from a balance sheet or income statement? Okay. The more detail you have, the more information you're going to have, right? So a cash disbursements journal is different from a balance sheet or income statement. The cash disbursements journal is just a summary of everything that you've paid. This will get turned into an income statement. Okay. But this is the running list, so to speak, of the expenses that I have paid in the cash basis world. So as I said, the more detail you have, you may have wanted to say, let's just go down here for instance here. Do I have anything that's broken down? No. You could say flower supply, I paid $52,300. I could have flowers. Now you may want to know, are those potted plants? Are they fresh cut flowers? Does flower supply also sell vases, ribbons, shrubbery, whatever. So how detailed you want to be to better manage your business, the more detail you should have. Now, years ago, back when laser printers first came out, printer cartridges were pretty pricey. And I can remember clients having they would set up their own books and then bring it to me, and they'd have office supplies. Then they would have sub accounts under office supplies, printer cartridges, paper, manila folders, whatever it may be. And it's like, is that really overkill? How much do you really want to know in printer cartridges that you spent? Now they're a dime a dozen, so to speak. Back then they were $100 or more. And so how much information do you want? What's the cost benefit? How much time do I want to spend categorizing this $52,300 versus, is it a waste of my time, or is it good information that I'm going to use? So that's kind of a it depends answer. So our balance sheet and income statement begins one from our cash disbursements journal, and the next one I have is the cash receipts journal. Now this is just for the month of December for Flossie. And so that's very similar in the concept. Here's the date I invoice and my different clients. Being a flower shop, rarely do I have an accounts receivable, so we're just going to pretend this is cash basis. So each client, how much they paid. So this is a debit going into my cash account, into my bank account. And Sally paid me $53.49. It was for a FTD order of $50. And based on that, I had to collect sales tax of $3.49. So again, you add up your different kinds of revenue, if I care, and then make sure that it balances out. Just similarly as the cash disbursements, all these columns add up to the $193,840. So that's the tying out or the reconciliation there. So the sales tax payable, the sales tax that you collect is not revenue to you. It is just, you are just acting as a fiduciary. You're acting as a pass-through. Your revenue for the month of December here for Flossie is the addition of the credit columns across. These are your income statement categories. So your revenue, let me just add this up, 1929.27, subtract 146.12. Your revenue for the month of December, if I did my math right, is 1783.15. So that across there should add up to that. So get the concept that the money that I collect for sales tax is not my money. You owe it to the state of Texas at some future point in time. So that's something that I have to pay later. Okay, questions? So debit bank account and credit customers. Yes, that's right. Credits, the be careful here of some terminology when you say customers. It's really your revenue accounts that you're crediting. It's your flower sales. It's your, for me, it's tax preparation fees. For psychologists, it's their counseling fees. Okay. So the debit and credit is with respect to bank or customer revenue account. The debit and credit, it depends on the account, depends on what we're doing. So in the cash receipts, when I'm collecting my money, I debit, I increase my cash account and credit my revenue. When I pay my stuff, pay my expenses, I'm decreasing my cash account, so I have to credit it. Does that make some sense? We're good? Okay, good. Any other questions before we move on? Losing you, sorry, can you repeat? About, what do you want me to repeat, Lisa? We're about the debits and credits on the cash accounts. Okay. On these two examples that I have, the cash disbursements and the cash receipts, let's go back a slide. When I pay something, I'm using my cash. So my cash account is decreasing. Okay. When I collect, well, let me go back. So my cash is decreasing, that's a credit, but I have to increase something else because debits have to equal credits. So in the cash disbursements, when I'm paying somebody, what did I buy? It is increasing, but my cash is going down. So that decreases, that's a credit. And when I'm collecting money, my cash is increasing, so that's a debit. And then my revenue are credits. So that is, and this is a little bit tough to get. So credits on the revenue is a credit. Let's just leave it as that. Just take my word for it, okay? Oops, I'm trying to get here to the chat. When pay something, cash account is decreasing, that's a credit. Collecting money, cash is increasing, so debit and revenue is credits. Yes, that's right. You got it. Okay. And part of it is, it's just the way it is. When I was in second grade, I remember my teacher holding up this piece of wood about yay long, and she said, this is a ruler. It's also known as a foot. It's also known as 12 inches. And I thought, what does this piece of wood, why is this thing called a foot? It's like, it's bigger than my foot. My mom's wore a size 4, so it was bigger than her foot. My dad's foot was about 12 inches. It's like, so what, you know, why is a ruler called a foot? I have no idea. It just is. So in part of this financial statement understanding, some of this, just go with it for me. And just go with it today as you work your own financials, as you have more experience. Some of these concepts will go, that's what Lisa was talking about. Okay, so don't beat yourself up if you don't get all of the concepts today. It just is. That's right. Just go with it. So debits and credits, certain accounts are typically debited and certain accounts are typically credited. So just go with it. Great. Okay, so this is what a balance sheet looks like without any numbers. Our assets, we have current assets, cash, our accounts receivable, our fixed assets, typically our furniture and equipment, if we had buildings, machinery, that sort of thing. Other assets, your organizational costs. So when you set up that LLC or corporation, those incorporation fees, those legal fees, that would be what would go in organizational costs. And then we have depreciation and amortization, which is a way to recognize an expense, recognize the cost of these items over time. So we add all that stuff up. We have total assets. Over here, we have liabilities and owner's equity. We have current liabilities. Current liabilities is anything that is due within the next 12 months. Long-term liabilities, things that are due beyond the 1 month, or excuse me, beyond the 1 year time frame. And our owner's equity, in this case, we would be talking about a sole proprietor, could be called members' equity, so on. Owner's capital, the money that you put in to start, the money that you take out, and then your current net income or loss, which this comes from your profit and loss statement, which I'll show you these with some numbers here in a bit. So our total assets equals our total liabilities and owner's equity. So that's what a balance sheet looks like, okay? These are the accounts that you would find on a balance sheet. Somebody have a question? Okay. Keep them coming in chat. Hopefully I've got everything here. Let me know if I've missed something in chat. Okay. So some terminology. In this equity section, let me go back here. Remember this section down here, this owner's equity section can have some different names. It can have what's called contributed capital, which would many times in the corporate world, you would be buying stock, buying common stocks. So in your S Corps and C Corps, you'll see common stock in that area. Capital can also mean retained earnings. Owner's draws means dividends or distributions. So as I mentioned in the S Corp world, when you take money out of the business account and put it in your personal checking account, that's called a shareholder distribution. In the C Corp world, it is known as a dividend. There's some differences here in the C Corp world on dividends, that there's a couple of you, I believe, that are C Corps. So let's just talk about this. Shareholders get dividends and wages. Okay, whoops. Shareholders in the S Corp world get wages, W-2 wages, payroll, and you can also have a distribution. In the C Corp world, you do get a W-2 wage, just like the S Corp, because by definition, you are an employee of that corporation, S Corp or C Corp. In the C Corp world, you would have a dividend. That dividend is not deductible on the corporation's tax return, but it is taxable income to you, the individual, you, the owner. That's where the concept of double taxation comes in. For the rest of us in the S Corp world or the proprietorship, LLC, partnership world, the money that we take out has absolutely nothing to do with how we figure our income tax. Okay. In the C Corp world, it does have something to do with your tax. So most small businesses are not a C Corp. If you are a C Corp, then many times you're looking to go public, you're looking for investors. There's some reason that you're looking beyond just having this business. You're looking to sell it. You're looking, as I said, for investors, angel investors. You're looking to go public, on the stock markets is the primary reason that in today's world you would choose to be a C Corp. There are some other reasons, but that's the majority of them. So C Corps, yes, that does have something to do with your personal tax return. And let me just draw this distinction as well when we're talking about C Corps and S Corps. If you are a corporation, you choose if you want to be treated as an S Corp for income tax purposes. The state of Texas doesn't care how you pay your federal taxes. They don't care what form you file. So an S Corp, the S, the letter S, comes from the Internal Revenue Code, a particular section, a particular paragraphs that talk about how an S Corp will be treated for income tax purposes. It is known as a flow-through entity. S Corps, partnerships, single member LLCs, and sole proprietors, all of those business structures are what's known as flow-through entities. It becomes part of your personal tax return. You pay your income tax for your business as part of the entire personal tax return. It's one of the, as I like to say, one of the puzzle pieces in your personal tax return. Puzzle pieces in your personal tax return consist of if you're married, if you're single, if you have children, if you have wages, if you have investments, if you have rental property, if you have a business, what's the flow through structure? There's lots of pieces to your personal tax return. So your business is one of those puzzle pieces for the total picture of your personal tax return. Unless you are a C Corp, the letter C, which again relates to a particular
code section in the Internal Revenue Code. So that's where that terminology comes through. Okay. Anything else, anybody? The profit and loss statement, also known as the income statement, is always for a period of time. Let's go back to the balance sheet. Let me point this out, which I failed to do. The balance sheet is as of a certain date. It's typically month end, quarter end, or year end. Small businesses and a cash basis tax return, we will always be a calendar year taxpayer. We will always look for that calendar year to show us what we will be paying and preparing, how we will prepare a tax return, meaning the numbers that we're going to use. So the profit and loss statement is always for a period. And so in the title, you would look to see, is this for the year? Is it for the month? Is it for the quarter? And you may have some extra columns out here that give you this month and a year-to-date number, which is very common to do. But typically, big picture here, P&L statement is your revenue minus your cost of goods sold equals your gross profit, minus your operating expenses, plus and minus, plus other income, minus other expenses, to come down here to your current net income number. That's the big picture of what a profit and loss statement is all about. So these are some terms as well that you will encounter. Some businesses will have cost of goods sold and some businesses will not. In my tax practice, I am not manufacturing anything. I'm not buying raw materials and turning it into something else to sell. All I'm doing is taking your data, putting it together in a tax return and handing it back to you. So I don't have cost of goods sold in my business. You may very well. So it depends on what your business is, what kinds of categories you're going to have, and how detailed you're going to be. Typically in the bottom here where you have your other income and other expenses, those are things that are not directly related to your business. It could be interest income from you have on your checking account. Sometimes in other expenses, it's if you, or other income would be if you sold an asset. Other expenses could be interest, depreciation, amortization. So it just depends on your business and what you've got going on, how many of these different categories you will see. Would services be put under cost of goods sold? Depends on what you mean by services, Karina. Typically, cost of goods sold, as I say, typically it's in that manufacturing environment where you're either buying something to resell or you're buying raw materials and putting things together to come up with a different product to sell. I have seen over the years people who are in a service business. Construction is a service that has cost of goods sold, yes. I have seen where people will, if they have a professional services firm, an architectural firm, I've seen an attorney's firm do this. So if you have a lot of employees and you have a lot of salaries, and that's what's really producing your revenue, is that you've got folks doing architectural drawings. Sometimes I've seen those wages put in this cost of goods sold section. So in the construction world, if you're building a home to sell, or you bought a piece of property and you're going to go in and remodel it and then sell it later, all of those costs, so you buy the property and you go in and do your remodeling, and so that is accumulating on your balance sheet under inventory because you have not done anything with it yet. So when you sell that house, then the cost that you have, total cost that you have in getting that house ready to sell would be your cost of goods sold. Asking for where might counseling, psychology, therapist, coaching, and mentoring services go. I would put that in, if I'm in
business coaching is a very common expense in today's world. So I would put that down in operating expenses. Or caring for elderly. Not quite sure where that is coming from, Sherry, what you mean for that. Okay. So here are some, again, some names that mean the same things, but you can, different names for the same idea. Profit and loss statement equals your income statement. Revenue can also be called sales. Cost of goods sold also could be called cost of products. Operating expenses, general and administrative, marketing and sales costs. So again, depends on what your business really is. Other income, as I mentioned, if you sold an asset, some interest income, other expense, income tax expense. If you're a C Corp world, you do not have income tax expense in any of our other flow-through business entity structures. So again, ask when you're talking with someone, or if you're starting out new and you're hiring a bookkeeper and you're not exactly sure of what to call something, what to categorize it as, talk with someone who's been around doing this stuff for a while, and they can lead you down the path of what the most general common answer would be. It's not rocket scientist, but again, when you start something new, it's all new, right? Okay, so let's see. We're going to delve into what a Flossie's financial statements look like here. But before I do, is there anything else that we want to clear up, or that I haven't really explained very well? Hopefully I've got everything here in chat that needs to be responded to. Okay. Not seeing anything else, not hearing anything else. Let's go to Flossie. So Flossie's financials are in the handouts as well, so you can have them a little bit easier sometimes to see. So Flossie the Florist, this is 2018. The balance sheet is as of December 31st. On the left-hand side, we have our assets, our liabilities, and our owner's equity. Yes, hopefully the question from Sherry, yes, hopefully these next couple of slides it's gonna come together for the journals and the balance sheets, etc. Okay, so the balance sheet is as of December 31st. At that time, we had cash in our checking account of $6,750. This is a simple financial statement, not much to it. We had some furniture and fixtures of $5,000, and we fully depreciated those. That's all Flossie has at this point in time. So her total assets are $6,750. As of December 31st, she owes to the bank on her credit line of $5,000. So during the year, what she owed to the bank on the credit line could have been $0. It could have been $10,000. It could have been $2,000, $8,000, whatever. But as of the end of the year, as of December 31st, she owed the bank $5,000. And in her equity section, so this just saying Flossie the Florist, and the equity section down here as such, you would assume that this would be a sole proprietor structure for her entity. So Flossie, this is her first year in business. That would be a question that I would probably ask as part of the story. She put in $1,000 to start. During the year, she took out $27,000, $27,165. That's money that she wrote out of her cash account and put in her personal bank account, put in her own pocket. Then for the year, her current net income for this year is $27,915. So her total owner's equity, when you do this math, is 1750. So you take the 5,000 plus the 1750 to get the total liabilities and equity of 6750. On the right-hand side is her income statement for the year ended December 31st, 2018. So she had sales of $200,000. Now we could have more detail here if we wanted to and have different kinds of sales. For instance, not in the florist world, but back to my personal experience of being a tax preparer. Back when I had my business in Austin, I had two partners, but we kept up with our financials every month. And we wanted to know what were our sales for individual tax returns. We wanted to know our sales for partnership tax returns. We wanted to know our sales for S Corp returns, C Corps, and then what we call generically consulting work, or we did a few financial statements. We did a few compilations, back to that first slide. And so those categories of income were important to us. And so we had those things listed under our sales category that would total up for the total for the year. But that was important to us. For Flossie right now, we don't care what her sales are made up of. But in your business, if you do care, then be more specific. You can call it sales, you can call it revenue. On my personal books that I keep for I have a little tiny tax practice now. I call it tax preparation services. Whatever means the most to you is what to call it, okay? So here in her cost of goods sold, we have these different categories of flowers, vases, delivery, and supplies, and those total up to $103,200. Now, these categories of these expenses, you should be able to go back to your cash disbursements journal and find those totals. So, and then looking at that cash disbursements journal, it would give you the details of who you bought flowers from, how often, who you bought them from, and what was the general price that you paid, right? Or your vases, who did I buy my vases from? So by looking into the details of these categories, I can tell if something has been misclassified or not. So that's what I'm looking for when I accept your work and accept your financial statements to do your tax return, is that I want to be able to look down, drill down, if you will, into the details of these categories and make sure everything looks like it's categorized correctly. Okay, so we have a cost of goods sold of 103. So her gross profit is $96,800. And she's had some general operating expenses listed here, which you can see. I included interest in this category. I did not separate it out. That's my choice. And so advertising, so on and so forth. Depreciation. Let's talk about depreciation for a moment. Depreciation is the method by which you recognize over time the cost of an asset. So if I buy a new desk, there are certain rules of how I recognize that expense. So my desk is $5,000 on my balance sheet because it's an asset that's going to last longer than a year. I have choices of how to depreciate it. There's book methods and there's tax methods. My small business clients, we typically will prepare this entry using the tax rules. Tax rules currently say you have 100% bonus depreciation, or what's called Section 179 depreciation. Those are two different things, but they end up with the same number. There's some other stuff behind the scenes that we don't need to talk about today. But what that means is when I buy a new asset or a used asset new to me that I'm going to use in my business, I can choose to depreciate the entire thing in the year I place it in service. That's what the latest round of tax laws with President Trump came about, was what's called 100% bonus depreciation. So in the year that I buy something new, I can recognize the expense of it in that year. By doing so, this number is bigger because a desk by tax rule says that is depreciated over 7 years. So I would take 1/7 of $5,000, and that would be my expense for this year, which means that would be a smaller number, right? So by having a bigger number, I have more expenses. Then I take my expenses, subtract from my gross profit to come down to my net income number. So if I have bigger expenses, my net income is smaller. If my net income is smaller, my tax return, my tax owed is going to be smaller. So questions or thoughts, comments so far from anybody here? Yes, you got it, Sherry. So I want to bring this to your attention. The net income for the year, the 27,915, becomes part of your equity section. So this is how these two statements, the balance sheet and the income statement, are tied together. The income or loss means she may have had more expenses than income, particularly if it's her first year. Many of us in our startup year, we will have more expenses than we have sales. So our net income or loss becomes part of our equity section. So that's a key concept to grab hold of. And I have to tell you, when I was in college many years ago, in learning to do all this stuff by hand, because it was before computers and software, accounting software, I could never wrap my head around that. It just didn't make sense to me. But over time, like I said, just go with me here. Over time, it's like, oh, that's how that works. Okay, got it. So this is her first year. She's got $6,700, $6,750 at the end of the year. She's bought some equipment. She's fully depreciated it. I can tell that just because of the numbers are the same. You know, she's done pretty good to have $27,000 for the first year. And I know that Flossie has taken $27,165 out of the business checking account and put in her pocket. Why is that important? Well, it makes everything balanced because we have to account for everything, right? But if I were to buy Flossie's business, I want to know how much the owner is getting out of the business. Well, that's one indication right there, is that she's put cash in her pocket of $27,000 for this year. Will that trend continue? Will it get bigger? She could take less money and have more cash that she could buy some more supplies with, perhaps. So what's going on? What's happening? Is the story, you know, the part of it is you ask the questions like, so maybe I want to know what kind of flowers I buy, or what kind of advertising did she do that cost $2,500? Did that advertising work? Can I track when I paid for this advertising and track when I saw my sales coming in? Okay. Why does her draw not equal her current net income? It will never equal, or shouldn't ever equal. It's just a misnomer here that it's that close. So draw is all about how much cash do I have? When have I collected my money? When have I spent it? How much cash do I have? How much cash do I want to put in my own pocket? How much cash do I need to leave in the business for next month's expenses? If I don't have any sales next month, I still have to come up with my rents. Looks like $1,000 a month here in this scenario. I still have, and wages down here. Wages means I have employees, that Flossie has employees. In this scenario, we are not Flossie the Florist Inc. This means wages means it's somebody else. She has employed some folks. So this number can be anything that she wanted it to be, meaning how much did she put in her own pocket? Any other thoughts or questions?
Draws are not taxable income. In the flow-through entity structures of partnerships, single member LLCs, and sole proprietors, this number over here, the 27,915, is what is going to hit her tax return. As part of her tax return, her business will complete a form Schedule C, the letter C for sole proprietors and single member LLCs. And it will, if this is a cash basis statement, which we are assuming it is because we see nothing about receivables and payables other than the credit line here. Then her Schedule C, her tax return page, that's part of her total personal return, the page for her business is going to be these numbers over here. So her tax, her income tax is going to be figured on the net income number that gets added to her W-2 wages. If she had any from another employer, if she's married, if her spouse works, what have you, this becomes part of her tax return for the income tax calculation. Also, this number, which is more relevant to a tax class that I teach and have taught for Round Rock, is a tax class. We talk about self-employment tax. We talk about how we as self-employed people pay into the Social Security system. And so in our world of, again, partners, LLCs, and sole proprietors, we pay into the Social Security system based on this number. So we have two parts to look at in our tax return: income tax and self-employment tax. Okay, let's see what this question. For the bookkeeping, at what pacing should Flossie put money in her own pocket? Does Flossie pay herself at the beginning of the month, at the end of the month, beginning of the year, at the end of the year? What's the name of the class? It's a tax class. We're not scheduled to do it yet for SCORE, so I'm not sure what they have on their plate to offer, but I have taught a tax class in the past. So back to the draw question. When you take money out of your business, that's completely up to you. You can do it beginning of the month, the 10th of the month, every day of the month, once a year, whatever your needs are. Typically, you're going to need some money once or twice a month, just like if you were an employee and you got paid and then you go home and put that money in your personal bank account and pay your rent payment or your mortgage payment or buy your groceries or, you know, buy some new clothes, whatever it is that you pay for your utilities. So when and how much you take out of your business as a draw is your decision. Now, you want to make sure that you have cash in the bank, in your business bank account, that you can cover some expenses if your sales are not great next month, right? You've got fixed costs that you have to cover. So you want to have a cushion. What that cushion is different for every business, because what's my cash needs in my business are different than yours. It's, you know, if you're what's called a highly capitalized company, meaning you have a lot of investment in equipment, a lot of people, you're going to need a lot more money available to meet next month's needs than I do in a small business that I'm working from home. So what works best for you? I do think that there's a when you get to a point, which is probably a couple of years down the road, when things begin to have a flow that you can rely on, that you know your marketing is working, you've got your clients coming, your sales are happening pretty consistently, or they're growing at a certain rate over time, you know, you begin to take some money out regularly as you need it. You know, what do you need to run your own household? You're hoping that this business is going to contribute to that, meaning it's going to pay it all or not. You know, this may be a situation we don't know. Here's some other questions to ask.
Is Flossie married? Does her husband make a lot of money? Is this just kind of a fun thing to do? And she just happens to have a pretty good business at $200,000 in sales. So, maybe this $27,000 was for the round the world vacation. Who knows? We need to ask more questions. So how does it relate to you is the bottom line. Okay. Okay, that's year one. Moving on to year two. What has happened? Well, let's take a look at this. Get my sheet in front of me here. Okay. We now have a new title. Home-based business, that's a different category. If you have a home-based business, it's the same, you'll be having the same thing no matter what it is. I have a home-based tax practice right now. So my financials look the same as they did when I had partners and employees and an office. It's just got a little bit different categories and the numbers are a little bit different, right? But the home-based business, being able to have a home office deduction, that's a separate entity. That's another day's discussion. Okay. Okay, so year two, Flossie the Florist LLC. So we have changed from a sole proprietor to a limited liability company. And a limited liability company can be a one-person or a two-person or more entity. And so in looking down here at the equity section, we see it says members equity. We have more than one member. We have Flossie and we have Bossy. So this says Flossie has taken on a partner. And capital is Flossie's beginning capital from the prior year end. Her owner's equity was $1,750. So this becomes her new number on the second year. The terminology is it's closed into your equity is closed into your capital account. So Flossie's starting off with $1,750 and she's taken draws for this year of $22,500. Bossy has put in $5,000 this year. They are apparently 50-50 partners because they have taken out the same amount in draws. So if this had been an 80-20 partnership, meaning Flossie kept 80% of the ownership and Bossy kept 20, then that draw should be reflective of those different percentages. The equity is closed into the capital account. Basically, it's or it can be closed into retained earnings. It depends on, again, your flavor of your business entity that we have going on. So we know that Flossie's taken on a partner. She's also looks like we have an additional $10,000 in furniture and equipment purchases for this year. We have not depreciated all of them yet. We have a credit line. She's got some payroll tax payable. The amount that has been withheld from the employees' checks has to be remitted to the IRS, US Treasury. So there's a certain period of time that she has to remit that. So that she hasn't yet paid at the end of December. Remember, this is as of the last day of December. She owes her sales tax that she's collected in the month of December or quarterly, whatever. Again, depending on your business, the comptroller's office will tell you how often you have to remit your sales tax. The higher your sales, the more sales tax, the more often they're going to want it. So there's some people that are annual, others that are quarterly, and others that are monthly filers of sales tax. So again, depending on how big your numbers are, the more often you have to send it to the comptrollers. And we have a long-term liability now. We have bought some equipment of we owe on it $8,000. That's the ending principal On that note, at the end of the year, and again, this would come from either an amortization schedule or the bank's information that they have sent to us that would detail out how, when I borrow money, that's not revenue, it goes into my cash account and I owe it. So then I pay it down. When I pay down on that note, part of that is the principal repayment and part of it is interest that I have to pay interest on the use of somebody else's money. So on the balance sheet, we are looking for the principal balance, what I owe, not the interest portion, but what is the principal, what's left to repaid of the original money that I borrowed. So we have total assets of $40,050. We have total liabilities between current and long-term of $12,770. And then when you do the math here in the equity section, it comes down to $27,280 for total. Again, our assets equal our liabilities plus owner's equity. Here, our current net income for the year is $65,696, which comes from our profit and loss statement over here. So sales went up. We have our categories here that we can compare this year to last year. We may have another column out here that could be a comparison this year versus last year. So just for management information purposes. So our total cost of goods sold, 177, gross profit 173, and then we have our different categories of expenses. And our bottom line of net income, the second year out, is 65,696. And again, because the draws are 50-50, the same number, they're 50-50 partners. We know that Flossie took on a partner based on some of the changes in the terminology on the financial statements. Looks like she's done pretty good. You know, she's increased her sales, increased her net income, so things are working well. You might want to ask some questions of how many employees does she have? Did she add one person? If she's got a couple of part-timers, you know, what kinds of information might you want to know? If I was the banker, I might want to have some more questions about, okay, so you want to borrow some money from me, show me your numbers that I know that you can repay me. What did you mean by remit sales tax? That means pay the comptroller. I collect that sales tax. Remember back on the cash receipts journal that I had for the month of December, my sales or my revenue, but my sales tax that I collected is sales tax payable. That's not, even though I'm required to collect that money from my customers, it's not part of my revenue. I owe it to the state of Texas. So when I pay it to the state of Texas, meaning the Texas Comptroller's Office, another word for that is that I remit it, I pay it. What does closed mean? That means closed, those are what we refer to as closing entries. We at month end, at year end, we close last year's numbers into equity, so we start with a new number for this year. So if we close it on a monthly basis, if this was for the month of December, I only want to see December's information. I don't want to see everything else. So that's really not quite the right way to say that on a profit and loss statement. You would have the year-to-date numbers on a P&L. So I misspoke there. But the closing has all to do with the equity section of on the balance sheet of what's last year versus this year. I guess it might be the easiest way to say it. Okay. Any other questions? Anybody? So there's stories to the financials. There's stories to your financial statement. You know, anytime that you put money into a company or start a business, you are putting capital in. You may have another category down here called additional capital contributions. You know, when I take money out, that's a draw. So the equity section basically is a summary of money I have contributed, money I have taken out, plus or minus the net income for this year. And this net income, as you can see, when we went from last year to this year, Flossie's capital section went from 1,000 to 1,750, right? Because that's what we started with here. 1,750 was the net of her equity. So next year we close this into her capital. So it comes out to be 1,750. And this is um, the net of what you've got invested is what this basically means. What's last year versus this year? Just in an income statement, you may have another column that would be titled 12/31/18 and would have 2018's numbers listed alongside this. And so you could be looking at 350 versus 200,000. You say, oh, we went up 150,000 from last year. That's all I'm talking about is comparison purposes. The accounting software will let you choose what type of history you want to look at to compare to this year is what that means. Okay. So now let's turn to the cash flow statement. Unless we have any other questions. So cash flow is all about what is happening with cash. Where is it coming from? Where is it going to? Meaning, where is money coming from? Is it coming from sales? Is it coming from new loans? Is it coming from me, the owner? It's also known years ago, it was called sources and uses, sources of cash. Where is it coming from? And how am I using it? Where is it going to? Okay. So that's what a cash flow statement is all about. And here's an example of a cash flow statement for Flossie. It gets a little wordy, but if you can go with me here, excuse me, at the bottom, where I have the arrows, cash at the beginning of the year was 67.50. Cash at the end of the year was 35.050. So if we look back on Flossie's balance sheets, December 31st, 2018, cash was 67.50. So January 1st, 2019, my cash is 67.50, right? I haven't made any changes from midnight last night to 12:01 a.m. 2019. Cash at the end of 2019 is 35.050. So the difference is 28.30. How did I come up with an increase of cash of 28.30? That's what a cash flow statement is going to tell us. So we start with net income. Our net income from 2019, again, back to our balance sheet, our profit and loss statement for 2019, 65,696. Here we are. We start. Depreciation and amortization is what's known as a non-cash expense. Meaning I did not write a check for depreciation. There's no payee that's depreciation. So this is the expense on my profit and loss statement that is recognized based on my assets and my depreciation method I've chosen to recognize the cost of that asset over time. So it being non-cash, I didn't write a check for it, it gets added in. I've had a change in payables, which is not shown on our balance sheet at the moment, of 27.70. So if my payables go up, that means I have kept more money in my account. If my receivables go up or down, if my receivables go up, I have less cash. My receivables go down, I have more cash. So what are the changes there? Our capital expenditures, we bought some new furniture for $10,000 in 2019. We've had increases and decreases in our bank loans. Our credit line went down 3,000, so I used my cash to pay down on that credit line. I have new debt for my bank loan of 8. Bossy put in $5,000. The draws paid out was 45. So this terminology, cash flow from financing, is the net of all that. And so the net increase in cash is 28,000. 73 minus 35 is 28. So beginning of the year, the net increase, yada, 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 goes down at the end. So this is a great summary to know where your cash is coming from or where it's going to. It gets a little heady in the terminology of understanding if receivables are going up, that means I have less cash. If payables are going down, that means I've used my cash. So I don't see a cash flow statement used routinely by clients. I don't produce them when I used to do financials because people didn't want to pay me to do them. But understand that in QuickBooks, you can click a report that says, give me the cash flow statement. But again, go back to that idea of if garbage is in, you're going to get garbage out for a report. So you have to be very diligent in your data entry and knowing how to record things. Where are you going to record them? Are they recorded timely? Did I get everything accounted for? So that's part of the whole bookkeeping. A good bookkeeper, as I said earlier, is worth their weight in gold because they keep this up for you and they keep it categorized right. They keep your bank accounts balanced and reconciled, because that's the worst thing to do, is to realize you've got a math error in your bank account and you don't have as much cash as you thought you did. So I see a question asked earlier, what expense would you account for if you have a home-based business? A home-based business is not any different than any other business. You still are in business. You still some type of business entity structure, whatever it may be, sole proprietor, S corp, etc. But in addition to that normal business, whatever, no matter where you are based, if you happen to be working out of your home, then on your tax return, on your personal tax return, then you may have some additional expenses that you can use to lower your net income. And so your home-based businesses, meaning I'm using a room in my home or a space in my home. There's rules about home office deductions from the IRS, publication 587, talks about you have to have regular use and exclusive use of that area. So if you have an office, and you can see here, if you look at the video behind me, I'm working out of my home office. I use it for office, doing tax returns and doing workshops. And, if I had a bed in here and that my husband's grandkids came and spent the night, then it's not exclusive use to a business. So there's a lot of rules you have to jump through to have a home office deduction on your tax return. But having a business, I may not fit the rules to have a home office deduction, but I certainly have a business and I have to jump through all the hoops and all the financial statements. I should be jumping through all the same hoops as anybody who's got an office or a business located somewhere else. So So I see going to touch on how the cash disbursements journal, cash receipts journal tie into the balance sheet, P&L statement, cash flow. Okay, so when you go back to those journals that we were listing out the what I bought, those will, my terminology here is roll up into the profit and loss statement and the balance sheet. If we go back to the cash disbursements journal, let me see if it's these numbers across the bottom should, if I've done my math right and haven't made any errors, should track to the expenses that I have over here. You see the $5,000 in furniture and equipment from the cash disbursements journal shows up on the balance sheet here. Flowers of 82,300 shows up in the total of your cash disbursements journal. Let's go back there real quick to point it out. Right here. So this is all my different flower purchases of 82,300. So when I look at the financial statements, I may want to look deeper. What does this 82,300 made up of? And so I can look back to the cash disbursements journal. There's another report that your accounting software will generate for you, which is called a general ledger. And basically, the general ledger takes your cash receipts journal and your cash disbursements journal and puts them all in a general ledger. And then from the general ledger, your balance sheet and income statements are produced. So I've jumped over the step of showing you a general ledger, but it's the where it's tied together is that all the details, every purchase, every sale is recorded and they get summarized, summed up for the year, for the month. And then you can look at it and you put your sales minus your costs equals your net income. So the more categories you have just depends on what you want to have for your own information purposes. So depending on what you're buying, it will show up either on your assets, your cash, you're receiving money and spending money. So when you get all said and done, that's the balance at the end of the year. Your bank credit line, we know that we still owe the bank $5,000 at the end of the year, and this number will have started from 0, because if this is Flossie's first year, she borrowed money of 10, she paid back 8, she borrowed 3 more. So it'll be the details. You drill down into each account and you'll see the details, what happens if you want to look. So does that answer the question? What's the difference between cost of goods sold and operating expenses? It's where you classify stuff, basically. And to take that a step further, the cost of goods sold is the stuff that you put together that are the direct costs of your business. If you're a florist, to have any sales, you're going to be selling flowers. Doesn't necessarily mean you're going to have advertising. So the cost of goods sold is what is it that you are producing? What is it that you're selling? What goes into that total cost of goods sold? So for Flossie, it's these items. And manufacturing environments where there's lots of people, part of your cost of goods sold would be your salaries for the people that work in the production area of your business. You would allocate some of your depreciation for your building if you owned it, or allocate some of your rent to that portion of the facility that houses the place where you're putting together, you got your raw materials and you mix them up and you've got your end product. And so anything that it takes to produce that end product is your cost of goods sold. Does that answer the question on cost of goods sold? Oops. Let's see. Where would we find rules regarding depreciation? I would say talk to your tax preparer first. They are in the tax code, in the Internal Revenue Code. You can go to, there's different publications. The IRS website is very good. I would irs.gov, search on depreciation, and on that you'll have more than you ever want to know about how to figure depreciation. There's different ways to do it. Have I hit all of the questions in the chat? Because we're just about at 2:30 that I see on my clock. So I'll be happy to answer any other questions. If you have questions, once we are through, whoops, sorry. Oops, let me stop sharing here. In the PowerPoint, the last slide is my email address. And Lisa@sagespeaking.com. I'll be happy to answer any questions that you have. Just shoot me an email, put in the subject line something about the financial statement class so I know who you are. I'll be happy to answer questions at any time, clarify anything for you, be a little bit more specific for your particular business, whatever I can do to help. That's what I'm here for. So thank you for playing today. Thank you for all the interaction. I appreciate it. I hope that was of some value to you to spend 2 hours with me and with the SCORE folks and Gita at the library. Share my contact and chat, sure. Lisa@Sage Speaking. I can type. There you go. Thank you for those comments throughout the day. That hopefully it made some sense. Hopefully you're on your way now. Yep. Grant, you're on mute.
Thanks, folks, for showing up today. And Lisa just pointed out why accountants exist, I think. So, you know, you kind of need some help in a number of fields when you're starting a business, and that's one of them. So, so thanks for a great job. Thanks, everybody, for attending. You got any parting words, Gita? Otherwise, we'll see you next week.
Okay, great. Thank you all.
Thanks, Lisa.
Thank you.
You're welcome.
Goodbye.